In a bank, if GRC is not connecting the dots, someone is connecting the wrong ones. So far, we have looked at the components of GRC and how they work individually. In this module, we zoom out to see where GRC sits in the whole organization. In banking, GRC can't be a silo. It needs to link strategy, operations, technology, compliance, and risk into one coherent approach. We will explore how GRC acts as a connector between different departments, enabling collaboration instead of conflict. By the end of this module, you will understand not just what GRC does, but where it needs to sit and how it needs to operate to have real influence in a financial institution. So where does GRC actually sit within a bank? The answer, it depends. But it always touches multiple teams. GRC plays a cross-cutting role. It helps define and align risk tolerance, support the rollout of security and privacy controls, monitor compliance with both internal policies and external obligations, and push for improvement when things don't go as planned. In some banks, GRC is part of the information security team, reporting to the CISO. That's typically common when the focus is on control implementation, patching, and technical risks. In other banks, especially large ones, GRC reports to the Chief Risk Officer, the CRO, because it aligns closely with enterprise risk management, risk appetite, and regulatory obligations. In a few cases, GRC might also sit under compliance, internal audit, or even legal, especially when driven by regulatory risk or legal or litigation exposure. Now that we looked at where GRC might sit, let's explore how it interacts across the organization. GRC does not operate in a bubble. Its real strength lies in being um, embedded in processes, connected to decision makers, and responsive to change. In a bank, GRC connects with nearly every major function. With enterprise risk, it helps align cyber and operational risk with broader risk appetite statements. With legal and compliance, it ensures policies meet regulatory obligations like PRA rules, GDPR, or DORA. With information security, it tracks control effectiveness, exceptions, and incidents. With business units, it translates risk and compliance goals into actions, like securing customer onboarding or protecting payment platform. And with procurement and third-party risk, it helps vet and manage supplier-related risk. Think of GRC as both a translator and an enabler. By translator, turning policy into action. Being an enabler, it's helping teams meet their goals without violating rules of increasing risk. When GRC is integrated, not siloed, it becomes part of the fabric of daily operations. And that's when it adds real value. Let's wrap up this module by zooming out and look at how GRC connects the internal organizations to the external world. In banking, GRC acts as a bridge between internal controls and external expectations. Let's break it into three main groups. Number one, customers. Especially in business to business or corporate banking, customers want proof of your security posture. You may need to fill out security questionnaires, share your ISO 27001 certifications, or respond to audit requests. GRC helps gather and approve this evidence while ensuring it matches your current control environment. Then comes your suppliers, whether it's cloud services, fintech partners, or call center providers. Third-party risk is huge in banking. GRC helps assess vendors before onboarding and reviewing them periodically. The function also ensures contracts include breach notification terms audit rights, and control expectation. And finally, the regulators. From the PRA and FCA to the ECB and local data protection authorities, banks have lots of eyes on them. GRC supports the business by staying aware of guidance, submitting compliance evidence, and adjusting policies to meet changing rules. This also includes engaging in regulatory consultations, such as on DORA or new cyber incident reporting rules. In short, GRC keeps the whole ecosystem honest, inside and out.